Welcome to today's session. Today we're going to take a look at the macroeconomic environment and stock prices. This is part of our top-down evaluation of fundamental share price valuation. Today's session we're going to take a look at how certain macroeconomic factors will allow us in the long term to be able to predict the direction and the movement of markets. In the short term, we don't do nearly as well. We're constantly surprised when there are fundamental changes that happen very quickly. For example, collapses in the stock market in the 1920s, in the 1980s, and most recently in the 2020s. These changes, these shifts in the market, were predictable in the long term, but the actual timing, much less so. Share prices tend to lead economic cycles. Typically, stock markets are the most sensitive indicator of the future direction of the economy. Stock prices historically have been consistent in their ability to predict a turn in the economy. Although we do better when we're predicting recoveries than we are collapses. And that's partly because collapses tend to be precipitated by singular economic events. For example, in the 1920s, 1929, global geopolitical events led to a stock market collapse that was perhaps years in building. In the 1980s, an increase in automated trading led to a systemic collapse, which caused a stock market collapse, which took a couple of years to iron out. And in 2020, of course, we have coronavirus. The downturns typically follow a long period of stock market appreciation or a bull market. And the prediction of a following bear market has been in the works for years, but the timing was something that was very difficult to come up with. Some of the factors from the economy that help us to predict the direction of markets include general, global economic factors. These are things like the general level of productivity in the economy, structural changes in the way that we produce things in the economy, levels below capacity, our unemployment and underemployment rates, the overall distribution of income within those economy, general efficiency. These are things that help us to see which direction our ability to produce is heading. On top of that, we have other factors like interest rates and exchange rates, inflation, unemployment, and government policies that help us to make predictions. Our forecasts tend to, on average, be good. In the long term, our forecasts typically come true, and in the short term, our forecasts are much less predictable. We generally suggest that the first part of any kind of analysis is to try to understand the direction of the economy. We see that activity by banks, by government institutions, tends to help us also to predict the direction of the economy. Government spending, the fiscal policy of the government, and monetary policy set by central banks tend to be two of the greatest indicators of the direction of markets. And of course, governments can go too far in trying to prompt the market and result in produce resulting inflation and hyperinflation, as we've seen in many developed markets recently and developed markets in decades past. So things like the actions of the Bank of Canada and also the federal government and its budget balances tend to be important. The stock market and its reaction to these macroeconomic variables is measured through movements in stock indexes or indices. And an index is essentially an average of the share price of the component stocks within that index. Different indexes have different ways of tracking stocks. For example, the Dow Jones tracks the 30 largest blue chip stocks in the United States. The Standard & Poor's TSX index, the larger companies on the Toronto index. The S&P 500 is a broader index. The Russell 2000 and 3000 tend to track smaller stocks. The Toronto Venture Exchange, smaller stocks, the NASDAQ, technology stocks. So different indices track different types of stocks and give us slightly different information about the direction of the economy. These measures tell us in general how the average stock is doing at any point in time. It gives us an overall feeling for the market. It shows where in the business cycle the market is, and it helps us to be able to predict the future. It also aids investors in understanding what the worst possible outcome can be in a major downsized movement. It helps us to judge the overall performance, and of course, as we've seen in corporate finance, the volatility of our stock relative to the rest of the index is the measure beta that is so important to us. Now, to understand the effects of the economy, we need to take a look at things that are exogenous and endogenous. Exogenous means that they come from outside of the stock market, things that are going to be external factors or exogenous factors. They include things like the potential for production in the economy. What is the total economic capacity of our market? That's going to be determined by things like the level of productivity, the size of the economy, the amount of capital that we've got in the economy, the efficiency in converting capital into production, the natural resources, and so on. So what is our potential? Total level of production if everybody's working as hard as they possibly can. Another factor is going to be the corporate tax rate set by the government, but of course it's something that can vary as the government feels that it would be more suitable perhaps to prompt the economy than to hold it back. Level of government spending can be both a positive and a negative thing. In general, when the government spends on infrastructure and creates jobs and employment, when we're below our total production capacity, that can be a positive thing. If government is competing with the private sector for spending, that can be a negative thing if we're already operating at full production. Money supply is another factor. Too much money in the economy, we create inflation. Too little money in the economy, and we have a credit crunch. So the three of the last factors were government variables or government policy variables that can be controlled by the government and the decision they make. The first one is one of the conditions that we just live with. Among these determinants of stock prices, the level of government spending and monetary policy affect stock prices by affecting the level of total aggregate spending. What is going to be the spending in the economy? And tax rate is also going to determine whether or not companies perhaps decide not to produce at full capacity, and when they do produce it at a certain capacity, it'll affect the amount of money that they can pass on to the investors. So total aggregate spending, together with the economy's potential output, that endogenous variable, past changes in prices, are going to determine changes in the price level. And changes in the price level, of course, is the term that we also use to describe inflation. Now, in the model that follows, which is originally, I believe, produced by the Federal Reserve Bank of St. Louis, it describes an economy made up of exogenous and endogenous variables. The four exogenous variables we've already seen. Their ultimate effect on share price, the most important variable for us, is shown in this model. Now, share price is on the right. The exogenous variables are on the left. So on the left we have the corporate tax rate, T sub x, the level of government spending, or the change in government spending, is delta G, change in money supply, delta M, and the total output capacity in the economy is Y star. Government spending and changes in monetary policy are going to have an effect on the total output in the economy. That's delta Y. If there's a difference between the level of economic activity that we're attempting and our capacity to produce, then we create inflation. That's delta P. Delta P is going to affect things like the interest rate, that's R, that we have to pay. It also affect the real level of earnings after accounting for inflation. That's E star. Of course, our level of output, delta Y, is going to produce earnings, corporate earnings, and that's going to be affected by corporate taxes. So E is going to be affected by the level of output in the economy and the rate at which the government keeps some of that money through taxes. If taxes are decreasing because of government policy, that increases the overall level of earnings. In real terms, those earnings are going to be adjusted by the delta P. Delta P is affected by the change in the money supply that we saw earlier, delta M, and it's going to affect our prices, it's going to affect our discount rate, but it's also going to affect the real value of earnings after inflation. High levels of inflation make our earnings less significant. When people see what the current level of earnings, after accounting for tax, after accounting for inflation are, they make predictions about earnings in the future. And it's those future earnings and future dividends that are going to be important to investors. That becomes the numerator in the share price formula that we saw in corporate finance. Remember that the share price is going to be a function, or the value is going to be a function of the present value of future cash flows. Essentially our prediction of the real value of expected earnings. And in the denominator, we have the discount rate, R. 1 plus R to the power of N. So share price is going to increase with increased expectations of real earnings, and it's going to decrease with higher risk, higher interest rates, higher risk-free rate. So the share price is going to bring together all of these factors, and it's going to be essentially caused by, well, of course, the effects of management decisions, but also by these exogenous and endogenous changes that come from the market, the determinants of stock price. So ultimately, corporate earnings and inflation are going to affect our real earnings. That was the E star. Interest rates and the required rate of return are going to be affected by inflation as well. And so inflation is going to affect both the numerator and the denominator. Our stock prices are going to be affected by earnings and interest rates. And if the economy is prospering, earnings and stock prices will be rising, hopefully faster than the interest rates do. We saw in a simple dividend discount model that we looked at in corporate finance that the price of a stock today is going to be some kind of a function of expected earnings or dividends discounted at a rate of R minus G. So the greater the D or the greater the G, the more valuable the stock. The greater the R, the less valuable the stock. There's an inverse relationship between interest rates and stock prices, although it's not going to be perfect because remember, interest rates are going to affect both the numerator and the denominator. To understand how this affects within an overall market, we need to have estimates, therefore, of the stream of shareholder benefits, typically earnings and dividends. We also can work with a required rate of return or earnings multiple. Things like a price to earnings multiple. And the steps that we're going to take in estimating the earnings stream is going to be to estimate the change in the economy. If we think the economy is going up by 2% or 3%, that's going to be one of the predictors of our eventual corporate sales. If we do as well as the economy, GDP growth translates into corporate sales. And if we don't change the way that we produce, that translates into corporate earnings before tax. And if the government doesn't change the tax rate, that translates into corporate earnings after tax and our expected value that we use in the share price calculation. Once we forecasted our earnings expectations, we can now start to think about an earnings multiplier. Things like a price to earnings multiple. If we have an expectation that we're going to earn $1 per share next year and we have a typical 20 times price to earnings multiple, 20 times 1 gives us an expected value for our company of $20. $1 earnings per share times a standard $20 multiplier, or 20-time multiplier. Of course, the more volatile our earnings, the more difficult it's going to be to apply this. And we also can't just use historical patterns or historical numbers for price earnings multiples, because changes that come from the economy are going to also affect things. And for example, we have seen indices like the Toronto Stock Exchange, the S&P TSX index, with an average multiple of 40 times. More recently, In early March, it was hovering around 28 times, and people said that was overpriced. And today, it's probably around 23. So historical numbers may not be meaningful when we're trying to predict the future. The market moves by itself. They like to say that a rising tide lifts all the boats. In other words, when the stock market goes up, everybody's price earnings multiple rises, whether they're a great company or an average company. Also, price earnings ratios tend to be high when inflation and interest rates are low. So we would pay a higher price for a company with greater stability of earnings. And in order to be able to apply this, we need to be able to put the earnings and the multiplier together. So as I said, 20 times expected price earnings multiple for next year, $1 expected earnings per share, 20 times 1, our value expected is $20. Now, we've seen that the price earnings multiple is volatile. There's a great example of this provided by an economist called Robert Shiller, who looked at the average price earnings multiple in the United States, tried to make adjustments for regular business cycles, and produce something called the Shiller Cape model, or the Shiller Cape model. And you can see from the history of average price earnings multiples based on the Standard & Poor's Index in the United States, from the 1880s till today, there were times when the price earnings multiple on the left-hand side was as low as 5 times. By the 1920s, it rose to 30 times price earnings multiple with the 1929 bubble. After the collapse, dropped down to about 6 or 7 times price earnings multiple. A number of bubbles over the period in between. 1980s, again, it was in the range of 6 or 7. But by 1999, 2000, rose to be about 45 times, because a lot of the companies that were favored by the stock market during the dot-com bubble were tech companies with very low earnings, which gave us very, very high average price earnings multiples. And so now, if we're at a number of, more like 25 to 28, that looks like a more normal value, but still on the high side. If you think about price earnings multiples inverted, earnings over price, we have something called the capitalization ratio. And so if we have a 10 times price earnings multiple, 1 over 10, if it's inverted, would be 1/10 or 10%. That suggests that the average rate of return to that market is 10%, or you're replacing your capital in 10 years. And so if that sounds fair to you, then you would say, I would be happy with a 10 times price earnings multiple. If you want a 5% average rate of return, or to replace your capital investment every 20 years, then you'd be happy with a 20 to 1 price to earnings multiple. Now, that's one of the ways, or a couple of ways, of looking at the most commonly quoted business statistic, that price earnings multiple. It is difficult to consistently forecast the stock market on a day-to-day basis. Our short-term predictions tend to be significantly out of line. Our long-term predictions much better. The efficient market hypothesis that we talk about in corporate finance essentially says that you can't predict an exact outcome in the future based on past information, largely because you can't predict timing. Market timing really doesn't work. Although we see times when the market does look like it's significantly underpriced, and there are bargains to be had, so it's a good time to shift from cash and into stocks. And at other times it looks like the market is generally overpriced, and it's a good time to move from stocks and back into cash. One of the most important messages that we have learned, especially from the years immediately after the 2008 collapse, was that you can miss an awful lot more by missing out on a bull market than you can possibly lose by dodging a bear market. People that took their money out of the market in 2009, when they saw that the market had already collapsed, and said things are going to get worse because we have systemic problems in the financial system and stocks really don't mean anything, saw a rise in the market from 2009, mostly from 2011, right through until recently, in the most recent bull market, that would have covered their losses 10 times over at least. So understanding the business cycle may help us to make forecasts. There's a relationship between stock market prices and the economy. The market is certainly going to be informed by the business cycle, but we need to be able to consider those turning points well in advance before they occur, because as we've said before, the market leads the economy. Stock market returns could be negative when the business cycle peaks and are likely to become positive when the cycle bottoms. So if you see a turn in the cycle, time to go into stocks. If you can recognize the bottoming of the economy before it occurs and a market rise is predicted, you would switch into stocks and out of cash. As the economy recovers, stock prices are going to rise, perhaps level off, and then eventually decline. Based on the past, the market price earnings multiple rises just before the end of a slump. One of the best known market indicators is the price earnings multiples, but we can also use other measures like dividend yield, earnings yield, which are also, as we see, related to share price. Dividend yield is a measure of dividends relative to share price. Earnings yield is the earnings per share over the dividend, or the capitalization ratio. So those may be indicators that we follow, as well as price earnings, but essentially they provide us with similar or the same information. Some of the problems with those indicators, they don't by themselves signal a change. That change may be something that we have to interpret. The signal itself may be unreliable because we have short-term fluctuations, we have false bottoms and false tops, we have W-shaped recoveries, and we have peaks that appear to be followed by corrections, which are followed by even bigger peaks. So the change occurring after our signal, long after our signal, is not going to be a very valuable indicator at all. If we have a predictor that immediately predicts what's going to happen tomorrow or next week, that would be valuable. Something that predicts change that could be coming in a year's time, not very valuable at all. So in conclusion, we'd say that using macroeconomic factors to be able to predict what's going to happen to the market is not going to be a perfectly simple and applicable tool. Our tools are all going to be subject to error. We need to be able to count on major events upsetting our predictions. Intelligent and useful forecasts of the market can be made at times, but those predictors are most likely going to tell us about the direction of the market and not about timing. I hope that's been useful, and look forward to talking to you in the next video or in class.